Hello friends, I hope every single one of you is doing well. I'm here with the second session of the free price action course that I promised, and in the previous session we talked about the general aspects of analysis and technicals. Now let's continue from where we left off. Price action analysis styles, along with the classic technicals that we were taught before and other important points, are areas where I have tried to create a new perspective in you for examining and analyzing the price charts of various different currencies. And we agreed that from now on, we will look at the market as a place shaped by traders' decisions which are the driving force behind price changes. We will carefully observe and analyze everything we see on the price chart, always basing our understanding on the mental image we form in our minds of those traders' decisions and intentions. In this way, every time we examine a chart, we remind ourselves that each price movement reflects the choices made by real people in the market. In this session, we want to talk about this. Okay, now we've decided to say, okay, if I can identify traders' decisions, if I can predict when they're going to decide to buy, well, I'll buy before them. Well done, Moin, you told us a point that seems very attractive, but how is it possible? Can I even guess? No, guys, we can't guess at what price all traders are going to buy or sell or which currency they'll buy or sell. Every trader might decide based on different data. One might buy based on fundamental analysis, like seeing a news item and just buying. Okay? People buy and sell under the influence of various data. One might use only technical analysis, like waiting for a pattern to form before buying or selling, and some people act based on others' opinions, like waiting for Moin Ghaffari to say buy before they go and buy or sell. Some have a view where they decide based on macroeconomic data, whether to be a buyer or seller in the market now, or some might combine these. One might have a fight with his wife at night and decide to sell in the morning. Another one, I don't know, is frustrated and decides to buy so they don't miss out. They do something under the influence of FOMO because their friend bought. For example, it's gone up and they don't want to be left behind. So all these factors might influence traders' decisions, even mental and emotional factors, cognitive biases, and how much focus they have at that moment. A trader might even make a trade that goes against everything that seems logical to you and me. So we can't predict all decisions at all price levels. Price doesn't move based on mathematics. Let's just put that out of our minds. We talked about this a lot in the last session. Look, price doesn't move based on patterns. There's no pattern that's always going to repeat itself. Even if there was a pattern that, based on research, we see worked mathematically in many instances, the reason was still that same price action and the trader's decisions. I mean, I can convince you, bring any classic pattern and I'll explain it to you without you needing to memorize it, like the head and shoulders. Without you needing to memorize that there must be a left shoulder, a higher peak, and a right shoulder, and once this pattern completes, the price is supposed to drop. Without you even wanting to memorize this shape, I'll prove to you that you can understand that the right peak that forms, or that right shoulder, as classic analysts call it, is a good place to sell, even before the pattern is actually completed. It has a logical reason in terms of trader decisions and this style that we're going to work on together. Well, price change can be the result of people's wrong analysis. It can be irrational decisions. Like I said, maybe he fought with his wife, or it could happen purely based on emotions. But in certain specific conditions, you can predict the behavior of the majority. For instance, in what situation can I predict that you are definitely upset? In a situation where someone betrays you, right? In what situation can I be sure that most likely out of 100 people on the street, 90 of them are going to swear? In a situation where, for example, water is splashed on all of them from a height, you know? This person is in a state of desperation, in a state of anger, if you can make them angry. You've heard them say people show their true selves when they're angry. In the financial world, exactly the same thing happens. The place where we can predict people and their behavior is exactly when they've become desperate, worried, or angry. This is where people's behavior becomes predictable. For example, we wrote here that in times of crisis, when people are under stress and pressure, their behavior is very predictable. I even tested this once and posted it on my story. I mean, I came out of the room and smashed something hard. Beforehand, I said, well, I want to prove that I can predict the future. If I go out now, so-and-so will turn around, look in surprise, and be scared. So what did I do? I smashed the dish hard in the middle of the office, and when I came out of the room, that's exactly what happened to the person. Why was it predictable that they would do that? Because I knew this container was going to break. So that action, that thing that's going to push that person into the stage we're waiting for and make their behavior predictable for us, that's what I need to look for and find. Don't worry at all about thinking we're in sessions 1 and 2 stuck in theoretical topics. The core of the matter is these theoretical topics that you must understand. Drawing support and resistance lines is easy, guys. Once your mindset changes, if I can achieve this with you in these first 2 or 3 sessions, then you'll finally be able to properly grasp the concepts we want to move forward with practically. When do traders find themselves in such situations? When they realize their mistake. Meaning the person must have gone long, then realize they went long by mistake. Where does this happen? Where the price starts moving against their trade direction. They're in profit, but their profit is decreasing. This is where they get scared. Put yourself in their shoes. Put your pre-course self in their shoes. What would you do? What do you think caused you to lose? You'd be in profit. Your profit was decreasing. Oh no. Contrary to your analysis at that moment, what if this profit vanishes? Let me take some profit. What if this profit vanishes? Let me get out. But you're patient with your losses. Right? Actually, a trade that goes into profit and then starts decreasing, that's the trade that scares you, makes you desperate. I can predict your decision. You at that moment, okay? You either go risk-free or you exit right there, and your exit from the trade causes the price to return to your entry point, and then it hits your entry point. Then it moves upward again. You say, I knew it was going to go up. This trade would have given 500% profit if I had stayed. My take profit was 100% profit, including my leverage, but I exited with 20%. You're the one to blame for this. Of course, you could say the blame lies with the mindset that has prevailed in the trading world and in the topics taught until today. And there's been more effort to instill in you, to tell you to control your emotions. No one told you how to analyze so that you can control your emotions. Well, when your profit decreases or you go into a loss, these 2 situations make you feel desperate. So it also makes the lambs feel desperate. Keep these in mind. You should write these down, guys. When we move forward on the chart, we'll get to these. I'll point them out. Guys, here, this is where the person gets desperate. This is where you should have entered the trade beforehand. In the trading game, we must understand at what point most traders realize they've made a mistake in their decision making. When we trade based on this, we have an efficient analysis. We enter trades at points where most traders are forced to take action, meaning I enter a trade where others are hitting their stop losses. Their stop losses move the price, and this price movement can increase my profit, allowing me to enter at the point with a smaller stop loss and a more logical profit target relative to my risk. Those people take action because they're forced to do something. When their profit is shrinking, they have to act. When they go into a loss, they eventually have to do something. Their stop losses have to be triggered at some point. This action of theirs changes the order flow. As we explained, the stop loss for a buy trade is a sell. Okay? Someone who bought at 10 and sets a stop loss at 9 is selling at 9. The price dropped from 10 and this causes it to move further down past 9. Okay? The stop loss for a sell trade is a buy. If I short at 10 and set a stop loss at 11, hitting that stop loss pushes the price up. Why? Because I'm buying to cover my position. Consequently, I'm changing the order flow, and even if I'm wrong, guys, if I trade where this happens, I'll incur a smaller loss. Because I didn't wait for a pattern to form before entering the trade. I didn't wait for a trigger to enter the trade. Meaning my trigger happens on a lower time frame, not the trading time frame. Even if I wanted a trigger with the current strategy our group is working on and teaching, which is separate from technical analysis and is about a specific strategy. You really need to know this important data in order to even use our group's strategy training or to develop and use a strategy for yourself. With our current strategy, given the market conditions, we aren't looking for triggers at all. It's a set and forget approach. Entry, take profit, and stop loss are set. Then we wait for the trade to activate, monitor it, and often we might decide to exit before the TP or stop is hit. Because our analysis is step by step. Candle by candle, we continue to analyze the trade we've made after it's opened. So if I have an effective analysis and analyze effectively, I'll have a more logical entry point. This entry point minimizes my stop loss and can yield larger profits. Regarding the entry confirmation, how should it be, guys? Once and for all. My entry confirmation should be 1 or 2 different factors, and I shouldn't be looking for 20 confirmations. Okay, a candlestick pattern must definitely form here. The price must be above the 100 moving average in my trading time frame. The 50 moving average must have crossed the 200 moving average upwards for me to go long. Each of these additions only results in fewer trading opportunities for you, and your stop loss will be further from your entry point. So the more confirmations we get, the worse it is, guys. Market context. Our analysis, again, I'll just explain it to you. If I have an analysis, okay, that has no context, my context, guys, is a playing field I have in whatever time frame I want to analyze. If, for example, I want to trade in the 4-hour time frame, I must have a clear playing field in the weekly time frame. Meaning if I see something in the 4-hour time frame that shows bullish strength, I shouldn't enter a buy trade when I'm at the weekly peak. Okay? If I see, for instance, a downward moving average cross has occurred, but where did it happen? I'm saying this as a classic analyst, mind you. We're not supposed to work with moving averages. But a classic analyst doesn't see the market context. They're just working with the moving average. They say, okay, downward moving average cross, I'll sell. Then what they do is this in the 1-hour time frame while we are still at the daily price floor. This is actually a mistake, and it ends up just ranging here for a while. Meaning they saw this downward cross, and after a point, these get tangled up, and then a trend change happens and they say, oh man, why is it that everywhere I cross, many places moving averages cross each other, the price pumps, the price dumps. So why does it range right where I enter? Because they don't see the market context. Market context, guys, in our view, in whatever time frame we're trading, for example, if we want to trade in 15 minutes, the market context becomes the supports and resistances that exist in the 4-hour time frame. I never open a short trade at 4-hour support in the 15-minute time frame, or open a long trade at the 4-hour peak in the 15-minute time frame. This is the market context, and now let's move on to, for example, an effective analysis. I do not want to spend too much time on it right now, but it is still worth mentioning briefly. Now guys, I entered a trade on Cyber at these 2 points, right? First, let's take a look at the moving average, for example. Where was my moving average in the 4-hour time frame? I had 2 entry points, one here and one here. It broke my moving average downwards once, then twice. Here I could say, oh, it's confirmed. Does the moving average make me exit my long trade? No. When I enter a trade in a range where other traders support my decision like this, I can trade with much more confidence and peace of mind. In the 50-minute time frame, I now have the chance to take profit or to go risk-free or to decide if it's even better to stay in this trade or not. But if you wait to get confirmation, okay? You say, okay, I'm waiting for this range to break, pull back here, for this pattern to form, for it to break, and then I'll enter the trade here. Look, if you enter the trade here, this is going to scare you. This is the point where you get scared. This is where you go risk-free, your profit starts to drop, and you get caught up in the very emotion I'm looking for to make my profit from you. Is that clear? I hope you found this session useful as well. If so, you can support us with your valuable likes and comments. Until we meet again, goodbye. May you have minimal losses and be successful.